Welcome again to Politico Competitive Week. My name is Jan Chansky. I'm a senior policy editor at Politico. We're going to be talking about competitiveness and the closely tied aspects of the Green Deal and decarbonization. That drive to clean up the EU's energy is also spurring, as that happens, is spurring a deep rethink of how to make the EU more competitive, which is crucial to allow it to hold its own against the US and China. Our guest is from a company that has been crucial to global warming, not necessarily in a good way. And I'm hoping that he's going to talk about that balance between growth and going green. I'd like to welcome Philippe Ducom, the president of ExxonMobil Europe, and a brief reminder to please talk about us on X or the social media of your choice with the hashtag Politico Competitive Week. Philippe, thanks very much for agreeing, and we've only got a very short time, so we're going to try to go quite quickly through the points. You've talked. We talked a bit earlier to sort of set this up, and you've talked about the Draghi report and competitiveness, and you have some fairly strong views on that.
Yeah, sure. And I think if you haven't heard the Draghi report 10 times or 15 times before the beginning of this session, you haven't need once. Definitely, it's a very important contribution to the debate on competitiveness. Competitiveness is very important to us, not only as a big company with a big presence in Europe, but also as an investor. If you take the big headline from the Draghi report, is that in order to rebuild its competitiveness and accelerate its energy transition, Europe needs to invest 800 billion a year. And that's a really big money. In fact, when he puts that into context, he says that if Europe cannot improve its productivity, Europe will have a problem to meet its 4 key objectives, and we talked a lot about the economic one this morning, obviously decarbonization, innovation as well, and social goals. And in other words, if it cannot meet that objective, it will have to start choosing and probably downscaling many of the ambitions that are already on the table. When we look at it as an investor, and frankly, we're deeply invested in the success of Europe, and we want to play an important part in the decarbonization of Europe, we have $20 billion that we have earmarked to invest in low-carbon solution, in reducing emission globally. This is mostly in hydrogen, biofuels, carbon capture and storage, and lithium. And right now, we see Europe not competing for this investment. And it's not competing for this investment because of some of the key elements mentioned in the Draghi report, in particular, a very heavy regulatory burden. When we think about the Draghi report, there are 3 things that we find are very important and should be enacted by the Commission really quickly. The 25% reduction in reporting burden that has been announced by the Commission last year, urgently need to put that in place. There is the competitiveness checks. That is not a common practice, but definitely has contributed to the loss of competitiveness that we see in Europe. And third, looking at some of the most problematic directives, in particular, as we look at it, those related to sustainability, the Corporate Reporting Sustainability Directive or the Corporate Sustainability Due Diligence Directive, 2 directives that are in the Draghi report mentioned as very burdensome for industry and for the business. And I think those are good examples of regulation that should be stopped and put into the competitiveness check and adjusted as necessary. What is encouraging is that clearly competitiveness is at the top of the agenda for the Commission, the Parliament, the Council. But I think as business participants and business players, we want to see action. Now it's time to put all this into action. We have been talking about competitiveness for the past at least 2 years. And right now, we have not seen any improvement. On the contrary, the past 2 years have resulted in more regulation, more burden on industry, and therefore less competitiveness.
So your contention is that there's 20 billion, which to put into perspective is basically twice as much as the company's quarterly profits in the second quarter. So it's not. It sounds large, but it's as a percentage of the business is maybe not enormous. But what specific changes do you want to EU legislation that would prompt you to put some of that money into the EU versus into the US?
I think the first thing you need to do is step back a little bit and think about what Europe is trying to achieve. Energy transition, going towards net zero. And what we're seeing is that right now, Europe is not going to meet its own objectives because Europe is having a very hard time to attract investment. Europe is not attractive, especially not attractive compared to other parts of the world. So what we would want to see is definitely the fact that we need regulations. There's no question about that. But that those regulations are more open, are focused on helping create a business case for industry, and are not the current approach that we see in Europe, which is very much about mandates. We talked a lot about bans this morning and yesterday. It's about telling investors what to do, where to do it, how to do it, et cetera, rather than taking a more open approach, which is about setting big picture objective, creating enabling conditions, and from there, enabling all the business participants, all the investors to compete and bring the best opportunities forward. So when you look at our case, and you mentioned the differences between, say, US and Europe, and it's absolutely true that right now, the majority of the investment we're talking about would go to the United States. We have four concrete, for the United States and Canada, we have four concrete projects. One is about the largest clean hydrogen plant in the world in Baytown, Texas, 900,000 tons a year in one project. The second one is about lithium extraction in Arkansas using a new technology called extraction technology, also very exciting, enough lithium to make batteries for 1 million cars. We have 4 signed contracts with third parties to practice carbon capture and storage. We would be the storage entity in the United States for a total of 5.5 million tons a year. And we are working on a biofuels project. It's under construction. This one is Canada, which is not just the US. And this project is intended to produce biodiesel for the Canadian demand. What's common in all this, it's enabled by regulation. It's enabled by the IRA in the United States. It's enabled by fuel standards in Canada. In both cases, the government have looked for how to help create a business case, how to support industry by setting objectives and letting industry compete to meet these objectives. What do we see in Europe? Well, in Europe, in the case of carbon capture and storage, it is the Net Zero Industry Act. And in the Net Zero Industry Act, instead of trying to help create a business case, instead of trying to work with industry to facilitate investment, the Net Zero Industry Act creates a mandate for oil and gas producers who produced in the past to invest in injection capacity. That is very unlikely to be a good model for the development of a new business for the future. Whereas in the US, it is happening through a completely different model. So I think it's this, sometimes we take the simplistic approach of the carrot and the sticks, and Europe having very few carrots and a lot of sticks, and US having some carrots and fewer sticks. I think finding this right equilibrium, creating incentives for investment, and not mandates and requirements. That would be really helpful. I think...
So, but basically, until that changes in Europe, unless you see some more carrots coming your way, you're not going to invest in these schemes in the EU.
You know, ultimately, a big international company, I speak for mine, but I think many others here in the room would say the same thing. We have a limited amount of capital and of resources we can put into this kind of projects, and I'll come back to that in a second. We have to find a way to get the maximum impact out of the dollars we invest. And right now, it's very clear that in Europe, we would not have the maximum impact for the dollars we invest, and that we are going to get a lot more impact on society and decarbonization by investing these dollars elsewhere. I think what's very important here, and when you think about it from a European context, and I heard it at least twice this morning, we need to bring business on board. We need to consult business. I cannot agree more with that, because if something is clear, is that industry will play a very important role in decarbonizing Europe. We bring the capabilities, we bring the technology, we can invest billions of euros, of dollars in projects. That's what we do for a living. Unfortunately, if we are not enabled, what we are going to see is decarbonization by deindustrialization. And by the way, this has already started. This would have very negative consequences in terms of jobs, in terms of, we talked a lot about security this morning, about supply security, about of cost to citizens. I mean, all of this, we will be and are enablers to the energy transition here, and we want to play our part. But we need to also find a fertile ground when investment is required. I think this is becoming increasingly understood, and I would add that clearly Europe is trying to do the right thing, but it's not going about it the right way. It's going about it the wrong way. And by adjusting the approach, by simplifying regulations, by avoiding duplication, overlaps, sometimes contradicting regulation, making the environment simpler, that would definitely be more helpful. And I'm not the only one saying that. I don't know how many of you are familiar with the European Roundtable for Industry, but last month they published their last report and poll. 91% of the CEOs in the European Roundtable say that the number one thing they need to see as a signal for improved business environment and attractiveness is a reduction of regulatory burden.
So Darren Woods, your global CEO, has said that big oil is not responsible for the climate or to blame for the climate crisis, but rather that it's consumers who are unwilling to pay more for the clean energy transition. How does the EU's approach or the Draghi report address that issue? Does it make consumers, in Exxon's view, more willing to pay for the transition?
I think the best way to describe how we look at the energy transition, it's not a simple, should we decarbonize or should we provide energy? No, the energy transition, the equation we're trying to solve is to how to meet society's need for reliable and affordable energy and reduce emission. It's not an or question. And in order to do that, we need to be enabled to implement those solutions we can bring. So it's really a question of how to do both at the same time. And I would say the key approach that is proving to be effective is to work on three things at the same time. And you cannot work on two out of the three. It's about policies that are supportive and that help drive investment. The second one is about technology. I think we talked quite a bit about innovation. But it's about enabling technologies, enabling the implementation of technologies that are available, but also enabling the development of the technologies that are needed and not yet there. And the third one is about consumer preference or development of markets. Ultimately, we can all hope that subsidies will solve the energy transition. That's absolutely not the case. We need to have market mechanisms that will help drive the behaviors of citizens like you and me to buy the low-cost product instead of the high-cost product. And it's by having those three things at the same time that we will be able to accelerate the energy transition at the lowest cost possible to society. And I think that's really what we're after and what we're advocating for.
Now, in the specific case of fossil fuel companies like yours, the argument could be made that the fossil fuel company helped create the climate crisis in the first place. So do you then get to benefit from lots of juicy carrots to shift your investment picture? Or should some sticks be coming your way to say, listen, you guys helped cause this. This is the regulatory thing. You need to fix the problem. And we're setting a regulatory direction for you to move in, as opposed to enticing you to move as if you were a startup, with no history in this issue.
I think it's important to step back here and understand the role of energy in prosperity. When we look at it, and every year we do our exercise we call the Global Outlook, which looks at energy needs across the world and key trends. First one is, yes, globally by 2050, emission will decline by about 25%, which is much better than the current trend, but not enough to meet the objective of the Paris Agreement. What's behind that? What's behind that in the growing need for energy in the developing nations? 15% more energy will be needed in 2050 than today. And that's a reality that is not built here, that is not born here, but that really is the reality of the developing nations. And when you look at how this 15% increase will be met, yes, renewable will play an important role. In fact, they will multiply by 5 in size. They will go from 2 to 11% of the global mix. But oil and gas will continue to be essential to meet that critical need. They will continue to meet a very substantial part, in particular industrial applications. Talk about competitiveness, that's very important in particular here. Talk about transportation application. In fact, 80% of the world's emissions come from those two sectors, and that's where we invest in, why we invest and where we invest, which is helping solve these, we're talking about it, hard to abate sectors. They are hard because it's expensive to do. And that's why we have earmarked this 20 billion to help reduce and invest in the decarbonization of our own facilities, but also others. But I think it's very important to realize that energy is absolutely critical to prosperity, and the question is not about should we choose energy or decarbonization. We have to absolutely do both.
Thank you very much. And we are, unfortunately, I would love that, I would wish that we had a much longer time to really dig into these issues, but we have what we have. So thank you, Philippe, very much for agreeing to this very brief chat. If you can please remain seated, the next session will take place after a very quick stage change, and our chief EU correspondent, Barbara Mons, will welcome Enrico Letta, the former Italian Prime Minister and author of the report on the future of the single market, for an interview. Thank you very much for your attention.